Today we are going to discuss about dividend distribution tax as discussed in Union Budget 2020. So first of all, we will discuss what were the reasons for removing the dividend distribution tax. Actually, if I tell you, dividend distribution tax was introduced in 2003. Before that, dividend distribution tax was not there, meaning the incidence of tax previously was on the recipient. Prior to 2003, the incidence of tax was actually on the recipient. However, in 2003, dividend distribution tax concept was introduced. So what are the main reasons for again removing the dividend distribution tax? The first one is this one. Foreign investors were not able to claim the credit of DDT. The dividend distribution tax was actually paid by the company. It was not paid by the foreign investors. Hence, the foreign investors could not claim the credit of the dividend distribution tax in their home countries. Okay, this was one reason, and the other reason was that the dividend distribution tax was paid by the company, and hence they were not able to take the benefit of lower rate of tax treaties. The one thing is that they were not able to claim the credit, and also they were not able to claim the benefit of lower rate of tax which was provided in the tax treaties. So these two were the main reasons for removing the dividend distribution tax in order to make India an investment, in order to make India investment rich company. Okay, so because of this, like in the budget speech, it has been said that the government will forego a revenue of 25,000 crores. So this will, open up opportunities for more investments, that is foreign investments by the foreign investors. So, and the other reason was that previously there was no proper infrastructure for tracking who has received the dividend, and now the infrastructure for tracking the dividend is there, due to which, like, actually the two main reasons are the foreign investors were not able to claim the credit of DDT, and also they were not able to utilize the benefit of lower rate in the tax treaties, because dividend distribution was taxed at the rate of 15%. However, in tax treaties they could have claimed the benefit of 5% and all those things. So these two were the main reasons. The first reason is this one, that is they were not able to claim the credit, and the second reason is they were not able to take the benefit of lower rate which was specified in the tax treaties. Now let us identify what are the other things which have been introduced along with the dividend distribution tax. So prior to finance bill, in addition to the normal tax liability, the company had to pay dividend distribution tax at the rate of 15% plus the surcharge and the cess. Now post finance bill 2020, what are the things? Now over here, the dividend tax incidence of dividend has been shifted to the recipient, because previously the company had to pay, now the recipient will have to pay. And there was a cap of 10 lakhs which was provided under section 115 BBDA. Now that is applicable only up till 31st March 2020. Whatever dividends are issued after 1/4/2020, no limit of 10 lakhs is applicable. No limit of 10 lakh under section 115 BBDA for dividends after 1/4/2020. Okay, and so if you remember, section 14A did not allow the expenditures which were related to the exempt income. Okay, so from now onwards, under section 57 we can take 20% of dividend income. 20% of dividend income we can claim as expense. We can claim as expense under section 57. Previously, section 14A did not allow the expenditure which were related to the exempted income as deduction. Now onwards, 20% of the dividend income will be allowed as expense. And so there is an introduction of section 80M as per the Finance Bill 2020. Now what is the concept of 80M? The main concept of 80M over here is avoiding double taxation. Now how is double taxation coming into picture over here? Now let us understand that by an example of a holding company and a subsidiary company. Okay, now suppose say the subsidiary company is issuing a dividend of rupees 100 to the holding company, and holding company in turn is giving the dividend to the shareholder in suppose say rupees 250. Okay, now holding company has received rupees 100 and given dividend to the shareholder of rupees 250. Now since the incidence of tax of dividend has been shifted to the recipient, now holding company has to pay dividend on this 100, and also the shareholder has to pay tax on the rupees 250, which includes rupees 100 as well. Now what is happening? Holding company is also paying tax on this 100, and also the shareholder is also paying tax on this 100, which is included in this 250, because of which there is a double taxation, because of which section 80M has been introduced, wherein it says that if the holding company distributes the dividend, which is not holding company, the section does not have any wordings regarding the holding company. It just says that if the company distributes the dividend which is received from any other domestic company on or before 1 month before the return filing date, 1 month prior to return filing date, 1 month before return filing date, meaning what? If the dividend is distributed by the holding company, if this 100 rupees dividend is distributed by the holding company 1 month prior to the return filing date, then in that case this 100 will be allowed as deduction. Suppose say if the holding company distributes to the shareholder instead of 250, if suppose say it distributes only rupees 80, then in that case the deduction to the holding company will be limited to the amount which is distributed to the shareholder 1 month prior to the return filing date. That means in this case it will be 80 rupees. Okay, so this is the concept of 80M. If you guys have any doubt, if any further doubts are there on 80M, then you can just mention me in the comment box. I will clarify it later on. Okay, and the next thing over here is that there is an introduction of TDS at the rate of 10% on the dividends distributed, that is under section 194. Okay, so from now onwards, okay, over here there is a cap of the amount of dividend distributed. So if the dividends are distributed more than 5,000, then TDS at the rate of 10% is to be deducted under section 194. Okay, so more than 5,000, 10% TDS. And the next thing over here is dividend which is received by the unit holders of the business trust is taxable in the hands of the recipient. Now in case of business trust, what happened was, if dividend is received by the business trust from any special purpose vehicle, then it is exempt. Okay, however, if unit holder is receiving any dividend from the business trust, then it is taxable, as in Finance Bill 2020 the incidence has been shifted to the recipient. However, if any dividend is received by the business trust from the special purpose vehicle, it is exempt under section 1023 FC. Okay, so this is the whole concept of dividend distribution tax. If you have any queries, please mention in the comment box. I will definitely solve it. If you like the video, please hit the like button and subscribe to my channel. Thank you very much.